Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30 minutes on Options Guide TV. We have a lot to talk about. The markets are still euphoric, I guess, wanting to set new highs. We're seeing some of the financial stocks sell off a little bit today. We still have the VIX index in a very complacency area, trading right around that 13% level. We're heading into the holidays, people are starting to talk about the Santa Claus rally that usually happens between Christmas and New Year's, and will it happen again, and the speculation that goes around it. And the SPX right now is down a smidge, down 11 points or 0.19% on the day. And the SPX trade that we did is really panning out. Now, I do know that a couple of people in the chat room, Mega in particular, someone with the handle Mega, or maybe that's their name, who knows, talked about closing out the trade at a dime or 20 cents. And we're looking at our butterfly trade that we did, and you could have closed it out on Wednesday and probably should have. But in hindsight, if you didn't, the trade is looking very interesting at this point in time. Because exactly what has happened is that we've had a little bit of volatility within where the current stock is at, but the SPX, I should say, the index, but the index has really gone nowhere over the week. And we find ourselves right back to basically where we started at. When we initially put this trade on, we were looking at the SPX at 6,066, so 6066, odd number that I just was able to screen grab. The market went up. We did the entire trade for $1. Well, let me set up the trade. Let me show you what the trade is. So let's hear 1 second. Give me a second, and let's go to the software. And in the software, here's the trade. And you could have gotten out on Wednesday. We always talk about from Wednesday to Thursday how good the time decay is. And then from Thursday to Friday, it is massive. And then from this point on, as the market approaches, it becomes extremely big. So this one is a tough call in that we put the trade on. The market was up here. This is the SPX highlighting it. The market was right in this range, right where these strike prices are at. Market went up, and that was profitable for the trade. Because we put it together on Monday, we were able to get it done for a net credit of $1.35 to the account. So we bought a butterfly and brought in a credit. And once again, and I'm going to keep emphasizing this because I think it is important to repeat hard to understand concepts, that in my idea of this trade, this was more that you're selling a credit spread to pay for a butterfly than any other thing. And that's why I like to call it a skip strike. We're skipping a strike in the butterfly, embedding a credit spread into the trade, and that credit spread is paying for that butterfly. Okay. So I usually then, if I have that attitude, just like any other credit spread, if I can close it out for a dime or a nickel, or if I can get 90% of the actual premium that I brought in, I want to close that out, and I want to take that risk off the table. So on Wednesday, the proper thing to do, as the market ran up and continued on up, it was to close the trade. That is basically the rules. But now I like the trade just to talk about as far as pricing is concerned. So that's what we're going to focus on right now. So here's our trade. Market was up here. We bought the 60-30 strike put, and then at the same time sold the 60-20 strike put 2 times. So that was a 10-point wide long put spread in our butterfly. Then we went down to the 60-10. We skipped that strike, and hence embedding the butterfly. Now, one way that you can think about this is that if you did the butterfly, the standard butterfly, you would have bought this 60-10 and you would have been 10 points wide on the long spread and 10 points wide on the short spread. But we skipped it and went down to the 6,000. Or you could say we bought that one and then we sold a credit spread to pay for it. So then you'd say, well, we bought it, but then we're going to sell it again and we're going to buy the 6,000 strike. And hence, I'm just explaining it as many ways as I possibly can. And hence we have a skip strike butterfly, which other people like to say is a modified butterfly or a broken wing, which I don't like it at all. Skip strike tells you what it does. Okay. So here we're at. Right now, this trade could be put on for, let's call it 50s. 55 is there. For 55 cents. In other words, if you put this trade on today, we put it on Monday, you would have to, with the market where it's at right now and the fact that it is Friday, the 13th, the day of the expiration of our option contracts right here, you would have to pay 55 cents. So if you flip the script and you close this, you would receive a net credit of 55 cents. So here's what's fun. If you put the trade on and fell asleep and didn't do as what was recommended to close the trade on Wednesday or Thursday, if you didn't do that, then you got lucky. The market has came down and you could have bought the butterfly, the skip strike butterfly, for a net credit of $1.35 and then closed or sold or unwind the butterfly right now for a net credit of 55 cents. And I'll show you that this way. Let's flip it. So here's how we would do that. Well, this would have been a sell to close. This would be a buy to close. I got to click open though. And this would have been a sell to close. And now you see that that is a net credit of 57 cents. I would say 55 is more feasible. And you would have did this entire trade for 155, that would be 40, $1.90 net credit to the account. That's what you would have brought in for doing the trade this week. And there really wasn't a time where you were afraid of the trade because the timing of the move to the downside is perfect. And this is where the hedge is at. If I was just in the short spread and I just sold the 60-10 and bought the 6,000, I'd be a little nervous right now. And the trade would be down. This trade happens to be up. And here's what the profit and loss graph looks like today. If you have any questions about this, please do put them in the chat box because this is a fairly tough concept, even though I've explained it many, many times. I can't assume that you've watched every Options Guide TV though. So we're at 6,039 here. This is the market flying. We'd have to pay a 55-cent net debit to get into the trade. So you see that here's the zero line, which is the dotted line across the middle. And this is down here because this is as of today. When we did it, this line would have been above the zero line and hung out right around $1.35. Now I'm showing you this just to show you how the time decay is happening, right? So this is real time using this quote with the market right here. If the market comes down, we're going to become more profitable each and every hour. And I'm going to add hours, okay? So we go to the, froze a little bit. There we go. So we're now at 10:57. Let's go to 11:57. Keep your eye over here. Okay. Let's do it 2 more hours. 11, 12, 13. We'll go 14. Yeah, because it's going to keep freezing on me. Okay. There you go. 13:57. Now you see this starting to move up and going into this peak. So at expiration, which is a few hours from now, it's 11 o'clock Eastern time. So 4 o'clock Eastern time is when we close. This has to look like that pitch. So let's go to 16. There we go. Finally, I got it to move. Okay. So this is where we're at right now. This is where we're going to be at with a very little time to the close in this scenario. And ultimately, all day long, this is just going to start withering away. So this would actually be this is I this is the ideal location at this point in time on this trade because you are getting into the massive amount of time decay. The 620 put needs to go away in order for you to make the maximum on the trade. So here is the dilemma. You could bring in 45 cents or 55 cents, and that's nothing to sneeze at right now. Like you could bring in this 55 cents into the account and add that to your total. Close it out. If the market stays where it's at, that 55 cents evaporates. It's just going to go away because anything that is above this strike does not behoove you on this trade. And you would lose that real nice little bonus that you got from doing the trade of 55 cents. Now, but if it stays and you head all the way up towards this expiration or you land somewhere between 630 and 620, well, that's a beautiful thing. And as a matter of fact, you could get this could be trading for as much of a net credit as $10 to the account. And if it continues on down, you also are doing okay. So you need it to land somewhere between the 630 and the 610, the strike that we skipped. And if that happens, then this was a home run. That's simple. If you land somewhere in there. So what do? I don't know the answer to that. If I had two of them on, I know the answer because I would sell one and then I would let one ride. And that would be the way that I would look at it. There is weakness in the market right now. And if the markets have a tendency to go with that, unless there's some mega news that has came out that's going to shift things, which usually you don't get that type of news on a Friday afternoon, but it can happen. People don't like to announce economic reports on Friday at 1:00 in the afternoon. So with all this said, I would stick with the momentum and let it run. Not just it's your idea, whatever you'd like to do with the trade. But I don't think if you were going to map out an SPX butterfly for the week and try to make it a learning lesson, this is the one. There's never been a better scenario. And this will be fun if it lands somewhere in the middle. But once again, you should have been out of the trade on Wednesday. All right. So now we got to, here, let's back out a little bit. 1 second. And I'm going to switch things up a little bit. Mega, are you out there? Did you close it on Wednesday? Did you get it done for a net, close it out for a small debit of like 20 cents on the trade? Just kind of curious if you did. And then now let's go back in and I'll pull up the Amazon trade. And we'll just kind of, we got two things that I want to look at. Okay, so BlackRock, we closed that trade out and the stock is doing fairly well. Okay, let's go back to the Tradier Pro software. And so the market ran up on us, kind of pegged us on our trade, came back down. It's kind of hanging out right here. I don't mind owning BlackRock in general, except for the deep in the money option contracts are just too wide. The bid-ask spreads are extremely wide to just jump back in and put this position back on. But we did close that out this week, and that was a profitable trade. The market just generally went up over the time that we owned the deep in the money call option and sold the shorter term option against it. And in Amazon, the markets came down a little bit, but we're staying the course. Strong parabolic move to the upside, which is really weird in how Amazon kind of worked in that they had a solid announcement on their earnings. The market took it positively and then came back down. And then they had a conference and they said the same things that they said on their earnings conference call. And the market decided now this time around it's good, and talking about AI and how it's making things easier for them to manage inventories, the work that they're doing behind the scenes to try to suggest products to retail clients, not to mention AWS and everything that's involved with that part of their business where AI is causing profits to be good on that side of the business. And if you look at it, the market came down a little bit at this point in time. So based off of the same news, the stock reacted differently, interesting enough. And now if we look at the Amazon trade, we did a short put spread. Market's at 226 right now. We sold the 182.50 and bought the 177. So we're still quite a bit out of the money on that trade. And I think we did it for like 50 cents. Let me grab my graphic here. And we'll probably just stay the course over the weekend on the Amazon trade. I don't anticipate doing anything fancy. Oh, shoot. Okay. That's where it went. Let me bring back up the Tradier Pro. And there's our trade. $0.40. Sold the DC20 expiration. And so we have 7 days remaining. We sold the 182.50. Oh, this isn't Google. This isn't Google. That's the trade that we did was Google, not Amazon. Okay. Sorry about that. Amazon was last week. Now it's making more sense. So here's the 20th, 182.50. We are right here. Sold that one. And then 182.50. So we're still one standard deviation away. Sold that one and then bought the 177.50. 29 cents. Okay, so on Google, we're having a down day today. When we did the trade, it was at 192.37. 192.37. We're at 190.78. We sold the 182.50. We bought the 177.50. We actually got that done for a net credit of 40 cents to the account. It's now trading at 30 cents. So time decay is working for you here. And we're still, well, we're 5 points away, well, the 7.5 points away from that strike. There's still a fairly high probability of the underlying not making it. Looking at the delta, we've got a 12% chance that it's going to come down to that range. I think we stay the course here. So that's the trade that we're going to leave on over the weekend is just Google. 182.50. We put it on for 40 cents. It's trading for 30 cents. I would take this trade off if we could get it done for a dime or a nickel. I don't want to try to pay 20 cents for it. I want to close it out in that range. And we have limited risk. We going 5 points wide. And I don't mind where Google is at right now. We got some weakness in the marketplace, but it's holding its own. So then it comes back to this week. Do we want to do in the SPX index? I wouldn't mind looking at a short-term butterfly, very short over the weekend. We want to put a trade on. I don't want to get long the market today on a Friday going into a Monday. But I don't mind doing a speculative butterfly, seeing if the downside momentum continues in the market and heads in that direction into Monday. So I haven't done many trades in the SPX that expire on a Tuesday or a Wednesday. Usually we do the Monday to Friday or put the trade on Wednesday and let that ride until Friday. A lot of it has to do with just the when we tape Options Guy TV. So I'd like to try this trade out. And once again, it's going to be a very speculative trade, riding the downside momentum on today. And it's going to be a 2-day butterfly. It's going to allow us to adjust it on Monday if we would like, and then it's going to close on Tuesday. And that's one of the things that's wonderful about the SPX is that you have so many different expirations to choose from, and they are liquid. And obviously, this is the case with the SPY too. So we're looking at the December 17th expiration right here. So 4 days away, and that includes the weekend. We want to be within the 1 standard deviation move because we do want the market to go down. But we're going to modify the butterfly. The VIX index right now trading around 13 will make it a little bit more expensive than if the VIX was a little higher. When you initially put on a trade in a butterfly trade, you want volatility to go up. And if you're correct, you want to be able to sell the premium because it's all about selling 2 option contracts on the middle strike of your butterfly. And you want to get as much premium for that as possible. So we're going to go 10 points wide. We're going to make it fairly simple. A lot of times if I'm doing this in my own account, I might go 15 points, but I don't want to have to pay too much for the trade. The biggest thing about being 15 points wide is, excuse me, is if the stock comes down to your strike, it allows you're wide long enough away that if the market comes down to the strike, it allows some time decay on the short option contracts because you're far enough away to get a little bit more time decay. That's the best way that I can explain it. It's just from years of trading. So obviously being able to go a little bit wider and having a little bit more upside is worth it to some people. But that also means you have more risk up front. If you have a potential for more reward, you're going to have more risk up front. So 60-30, we're going to buy this one here. We're going to go down. All right, we're going to let's look at the 10.1 and then let's look at the 15. I'm going to go down to 10. I don't want to spend too much on this because we're going to skip this strike. Okay, 630, 610. We're going to modify this, and instead of going to the 610, we're going to buy the 615. Okay, I'll show you what that does. So now that's $1.50. That's going to give us 10 points of upside. We have 2 days for this market to come down to that 630 level and trade within that range. If we send this to the what if calculator, 150 is inexpensive, real inexpensive, right? As far as a butterfly is concerned, especially a shorter term butterfly like this. And what this does is if you pay $1.50 for it, market is here, comes down to 630. It needs to land within the strike by Tuesday, the 17th. And if it blows through it, well, the butterfly is going to trade for $5. Why is that? It is because, and I have it down here so I can use these numbers, is the long spread from 630 to 620 is 10 points. The short spread, which pays for the long spread, which helps pay for the long spread, is from 620 to 615. So you have a 10-point wide long spread, which is doing your work for you. This is what helps you make money on the trade from here to here if you are correct on your forecast. The short spread is what hinders your trade, but it pays for it. So it reduces your risk, but then the risk kicks in from here to here. If you do a standard butterfly and you buy this strike, well, once it goes down below this range, you can lose money on the butterfly. In this instance, the short spread is 5 points wide and the long spread is 10 points wide. Okay. So from here on down, you still make $5 on the spread. You can still sell the butterfly spread for $5. You paid $150 for it, and you'll see that we're right on the $350 mark as far as the profit and loss is concerned. And that's $150. Okay, so let's change it up. That's extremely cheap. I was thinking it was going to be around $2 or $2.50 and somewhere in that range. But this isn't bad because we're only going 2 days to the December 17th. I think we can do it 15 points wide, which gives us a way better landing range, and probably pay the number that I was thinking, $2 or $2.50. Okay, so let's see. We're going to clear this out. Well, we got it in the what if, so that if we want to make that one the one, we'll do that. We're going to buy this one. We're going 15 points down to the 650. We're going to sell that one twice. And then we're going to stop short on this one. So this is 15 points wide. That would be 6,000. We're going to buy the 6,005 here. 205. There you go. I like that one way better. $2, and here's a $200 trade to do over the weekend in the SPX to see if this momentum to the downside continues going into the end of the day. Maybe get a little bit of downside on Monday, and we land somewhere around the 615 level. Right now, the Delta is saying there's about a 30% chance of that underlying stock coming down and finishing just below, or basically making the 660.15 strike in the money, because based off of that Delta, that's probability of the stock reaching that strike by that expiration date. And that's our trade. And that's our trade for this week. Let me go look. I haven't kept any mega. Yes, I was able to close for 20 cents. Okay. I closed it Wednesday and was fine with it. Also closed it for 20 cents. Yeah, excellent. Unfortunately, I did not fall asleep until I did not fall asleep until today, Anthony says. That's perfect, Anthony. I like that. Yeah, I can imagine that when 1,000 was down on the line. All right. Omega basically saying that, yeah, right now it's, well, you see the trade. You see how this was a textbook trade. Like if you were going to make up a trade to talk about the skip strike butterfly, it was this trade this week. This would be the numbers. I'll probably keep the screenshots from this week. Because you're right on the precipice right now. 60 right now, 6,043. We need to get down to 630. Yeah. So we'll find out on Monday, right? Because we'll come back and we'll look at our paper trade for this week. This one to me is a real speculative trade, in that you have a couple of days for it to live. You are paying $2 for it. So if the market stays where it's at or continues on up, you got to be prepared to lose the $2 for as many butterflies that you put on. But I don't mind riding this one into the weekend. Obviously, over the weekend on Monday, you're going to get the big rate of time decay, kind of like from Wednesday to Thursday, right? Or Monday would be that day. And then from Monday to Tuesday, that's like Thursday to Friday. So you're going to get a huge rate of time decay. This would allow us an adjustment, and we can adjust this trade on Monday if the market does go up and we still got some premium in it. We can roll into a short put spread. So there is an adjustment. It's so short term. It's hard to pull the adjustment off and make it worth the while. We'd have to bring in a decent net credit. But $2 is going to be the trade, and we're going to let it ride. All right. And I look at it, we're at time. So please follow me on Twitter. My handle is @BrianOverby. We do send these out live via x.com and in the Tradier platform and inside my x.com profile. And then you can follow us in hub.tradier.com, get access to all the speakers that Tradier sponsors, and also ask questions via that. If you sign up and you put a profile in, just give them your email. It's free to do. And then lastly, obviously, you can ask questions via the YouTube channel and the Tradier YouTube channel if you are logged into YouTube. Thanks for stopping, and we'll see you this Monday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.